Hey traders, welcome back to another lesson in this introductory course. This is lesson 6 and it's going to be talking about technical analysis, where we'll cover price action, trend, and support and resistance. So let's get into it. As you would remember, in the last lesson we spoke about the 3 types of analysis that traders use: technical, fundamental, and sentimental. We also highlighted the importance of technical analysis, as most traders lean on this analysis the most when trading. So for that reason, we'll place a much greater emphasis on technical analysis throughout the course. So let's start with understanding what exactly is technical analysis and refreshing your memory from the last lesson. So technical analysis, or TA, is a means of examining and predicting price movements in the financial markets by analyzing historical price charts. It's based on the idea that if a trader can identify previous price patterns, he can form a prediction of future price movements. Technical analysis will work better for all predictors if many traders make the same prediction. Therefore, technical analysis will work better when analyzing an instrument or stock traded by the masses, much like the US equity markets. It becomes somewhat of a self-fulfilling prophecy, because if the majority is expecting the same thing to happen and take the same action in anticipation, it will fuel the expected event. Importantly, technical analysis helps traders identify key components of a trade. These are the entry point, whether to go long or short; the stop loss, and this is at what point the trade idea is no longer valid. At what point should I take the loss? The position size for appropriate risk taking. How many shares should I take based on the distance to the stop loss from my entry? And lastly, profit targets. Where do I feel is the appropriate level to start to take profits? Technical analysis shows us all of these and can help us identify all of these points. It is the study of price movements, and those are represented on the chart, and they are translated into price trends, price signals, and price patterns. Let's now talk about price trend. So in technical analysis, we often do price trends analysis. The term trend refers to a general direction or movement in which something is developing or changing. In the financial markets, price is constantly moving as participants are making bets on where they think prices will go. When the majority of participants are in some form of agreement, this precipitates markets trading in a general direction and is representative of a trend in the markets. There are generally 3 types of trends: the uptrend, the downtrend, and sideways trend or ranging. Let's discuss the main elements of identifying these types of trends. Let's start with the uptrend. This is normally identified by higher lows and higher highs, each successive high accompanied by a higher trading volume as proof of an increase in buying pressure. Then we have a downtrend, and this is usually ruled by the sellers, where you have lower highs and lower lows, oftentimes with each successive low accompanied by higher trading volume as proof of an increase in selling pressure. And then we have sideways trend, where we'll see sideways action or ranging action, and is often associated with price consolidation. So a trend can continue for minutes, hours, days, months, and even years, and can also be observed over different time frames by participants with different motives. For instance, an investor will likely have a long-term investment horizon and may be happy to go long a stock watching a weekly chart in an uptrend, while on a specific day, a day trader may be taking advantage when the same stock is up 4% and going long an uptrending 5-minute chart. Both may be buying the stock at the same time because it is strong and in an uptrending market, but on different time frames. The key was that both participants were buying into the trend, anticipating that it would continue. So from that example, an important thing we must highlight is one should understand and accept that the trend is a representation of majority of the market participants' belief at the time. Therefore, trading with the trend helps increase the probability of a successful trade. The trend is your friend. Professional traders aim to buy the strongest markets and usually short the weakest markets. We'll continue to discuss this as the course continues, and complementing price trend analysis is support and resistance, our next topic. So, support and resistance. This is something you'll hear a lot when talking about the stock market and trading. Analyzing support and resistance areas, or for short SNR analysis, is one of the most compelling and important jobs of a technical trader. Support and resistance, just like price trend, reflects the participants' behavior and assumptions at that time. So support, what is support? Support is a price level or area where demand exceeds supply, generating a reversal higher in the price action, oftentimes called a bounce. The higher the volume and the more times price tests the area, the stronger it is. So why does price do this? Well, at support, you'll often have short sellers who sold a share at a high price closing their positions, and in order for a short seller to close their position, they have to buy to cover. So they are adding buying pressure there. And then a stock approaching a previously visited low will attract buyers that are looking to enter at a cheap area. So they're buying on the pullback. And then disappointed short sellers who are above their entry and are waiting for price to return to the entry point in order to exit without a loss will again be buying to cover and adding that buying pressure to the stock. So as we said before, support and resistance reflect the participants' behavior and assumptions, and that plays out in real life, establishing these levels. So let's now talk about resistance. Resistance is the opposite of support. It's a price level or area where supply exceeds demand, and this generates a move lower in price action, oftentimes called a rejection of the area. The higher the volume and the more times price tests the area, the stronger it is. So why does price do this at resistance areas? We're going to talk about the participants once more. Buyers who bought the stock at a low price are closing their positions. This would imply that they bought at the cheap, the price has now moved higher, and they're selling because they anticipate more selling to happen there. Again, self-fulfilling prophecy. And then you have the stocks approaching a previously visited high. This will attract short sellers who are looking for a technical entry point to anticipate the move lower as price will move in their favor. And then you have disappointed buyers who are below their entry point and are waiting for the price to return to the entry point in order to exit without a loss. So all three of these participants with different motives are becoming active at these price levels and areas. So now that we've established what support and resistance levels are and what the participants' motives are at those levels, how do we identify them on the chart? We have different techniques of identifying support and resistance, or anticipated support and resistance. The first one is round number SNR analysis. So using a round number, for example 100 or 200 price level, as this has historically been areas where investors psychologically prefer to buy or sell. The average investor thinks in round numbers and they think about executing according to these levels. Not many investors will go around saying they want to buy a stock at $100.15. Rather, they often round it up or round it down and will say, I'll buy it at 100 or I'll buy it at 101. And that makes for an increased demand or supply at these levels. And then we have horizontal SNR analysis. And this is where we use the chart, price action and key elements as we described above to identify support and resistance. These play an important role in defining technical patterns, and that's something we'll discuss in the next lesson, as well as trade decisions. So let's move on. Let's now look at an example involving trend and support and resistance. So in the example on the laptop screen to the left, we can see an Apple daily chart from January 2023 to June 2023. We can first see price ranging or no trend or even consolidating from the end of January to the middle of March 2023. You can see it clearly highlighted on the chart. We can also see a clear level of resistance which was eventually broken at 156.50 cents. This is also known as a semi-round number level, where the investor may not think of 156, but they'll round it up and say, I'll sell at 156.50. And again, this is how normal investors think. So after it broke that resistance level, you can see highlighted with the orange line on the chart, it went into a solid uptrend with higher highs and higher lows. Again, looking at the chart, we can see the price move up, peak, come down, and then reverse higher again and set a new peak. That is what we call the higher high, and you can see those dips moving up, which are called the higher lows. So further down the line, we can also see a clear level highlighted of support in May at 170.25 cents. You can see it highlighted with that green line on the chart. Again, these are just areas and also just two examples of support and resistance on the chart. If you look at that 170.25, you can see that price fails to move past that. It comes down and tests it at least 3 times before reversing higher and continuing the trend. So let's now back at the chart and see how many you can identify in terms of resistance, support, price consolidation, and trend in this solid uptrend for Apple over the period. And that's all for this lesson. It was great having you. Thanks for tuning in. We'll continue with more technical analysis in the next lesson. See you there.